back to our Insider Interview series. I'm Dave Baxter, Senior Fund Content Specialist here at II, and today I'm joined by Ian Mortimer, Co-Manager of the Guinness Global Innovators Fund. Ian, thanks very much for joining me.
Pleasure, thanks for having me.
If we look at performance, it's been pretty strong in the last year. What would you say have been the main contributors there, both in terms of the good returns and anything that might have dented performance somewhat?
Yeah, I think if you're thinking over 2026 sort of calendar year, I guess two things have driven performance on for a positive and a slightly negative point of view. And I think a lot of that is to do with tech. So clearly we've had this big divergence between what's perceived as the winners within tech and what's perceived as the losers. And this is all about the AI trade and Anthropic and co-work and all these tools we're seeing. And the difference has really been that growth and outperformance of the semiconductor space and maybe the underperformance of software. And I think if you look at the portfolio, we've had quite a, from a positive perspective, we've had a big overweight to semiconductors quite a long time. So I think we were quite early on that. I don't think we were necessarily increasing our weights to the semiconductor space in 2018 based on our view of what AI was going to be. But I think what we were seeing back then was if we think about those themes, we talk about the themes at the beginning of our strategy, the secular growth themes, a lot of those were to do with semiconductor demand. Electric vehicles, Internet of Things, building out of data centers and cloud, for example. And our view really was all about these were companies that were very cyclical in nature, and our view was that maybe if that demand was broadening, perhaps they would become less cyclical. So it wasn't necessarily they'd become just out and out growth plays, but that sort of the troughs would become shallower, the return on capital would generally be higher, and they'd have this good opportunity to reinvest and grow. So I think that's an area of the portfolio that's been a really big tailwind, and that's continued through 2026. I think on the other side has been companies like Salesforce, for example, that's been hit harder from the expectation that that's going to affect their business negatively, or other companies like Roper, for example, that owns a number of vertically integrated software businesses. I think the thing the market's trying to figure out, I think, on the software side is it's not necessarily completely clear yet which of those software companies potentially will benefit from AI, whether that's using AI within their business or the potential shift of business model from software as a service to maybe kind of use of software, so kind of a seat-based pricing model to how much are you using our products. And you can see that in terms of the earnings. So kind of if you look at the next 3 years consensus analyst earnings expectations for a lot of these kind of software companies, you're not seeing any changes. You're actually seeing quite a lot of improvements. So I think a lot of what the market's doing is saying, in say 3 years, 4 years, 5 years, what's going to happen to these companies? And you can see the big shifts in terms of some of that performance. Salesforce will sell off. It's definitely been a drag to our portfolio, as an example. And then there'll be periods where actually it rallies again, because I think the market, sort of the narrative is not yet completely clear. So I think that's been, kind of the two big drivers of the performance. But obviously our overweight semiconductors has generally been the kind of the tailwind. But we do own some software companies, and that's something we're actively looking at and reviewing to try and think about, should we keep owning these? Should we be topping them up? Is there, but from a valuation perspective, there could be opportunities there, but not all of them are going to work.
On the AI theme, how worried are you about the so-called hyperscalers and their massive level of spending on AI infrastructure?
Yeah, it's something we look at very closely, and I think there's pros. I guess there's sort of the balance, if you like, is so clearly the market has. If you think back to 2025. In very sort of being slightly simplifying, when the hyperscalers increased capex, which was one of the big drivers of market performance through Q2, Q3 last year, the market was essentially saying, the more you're increasing capex, we're going to take that as a proxy for increased demand. Therefore, we're going to reward you for that. Increase capex, you've got more demand, this is a growth story, stocks rise. I think as we've moved through into 2026, we've still seen those increases in capex, but that jump's actually been a bit higher through the last quarter of what we're seeing. And I think the market is beginning to question, what is the return on investment of that big capex spend, and is that going to come through? I think in many cases you can see that growth come through, and I think you're looking whether it's Microsoft or Azure or otherwise. I think you can see it. but we still haven't got the data points yet. I think in our view, the valuations on the flip side is, if that's wrong, the valuations are pretty moderate. And if you look at the valuations relative to the market, in some cases they're actually trading at a discount to the broad market for these big businesses today. If you compare those valuations to other kind of bubbles, whether it's a kind of 2001 sort of tech bust, for example, they're completely different. If you then look at their balance sheets, they're still really strong. So even though they're spending a lot of this money, it's still within cash flows from operations. So they can afford to do it. And if you look at their kind of debt levels, whether it's net to EBITDA or in absolute terms, you still see they're very robust. They've got a lot of cash and they can manage that. So I think in terms of the risk side, I think you can see some balances. If you look at something like Oracle, though, as the outlier, that's very different. And that's why the Oracle share price has reacted very differently. They're spending more than their cash flows. Their debt levels are much, much higher. They're having to raise a lot of debt to pay for this capex spend, and you can see the diversion in terms of how the markets are pricing it. So from our perspective, I think if we kind of add up those sort of the balances, I think we remain sort of relatively positive on those stocks. I think they still make up a reasonable portion of our portfolio, but I'd also note we run an equally weighted portfolio, so we don't have really big weights in those stocks. So I think to some extent we're managing that risk in terms of a stock-specific risk through our portfolio construction, as well as some of that work we're doing on valuation.
On the equal weight approach, that's quite an interesting trait. It is something many of the Guinness funds do have. But how tempted do you get to run your winners a bit more? Because with some of those names, you could have made a lot more money if you just stuck and allowed the position to grow larger.
Yeah, and I think hindsight's a wonderful thing, number one, I would say. And, like you say, if we'd have, just sort of kept NVIDIA for the last 20 years and we hadn't touched it, we'd have this incredible track record, but we'd have a very big, significant stock-specific risk. We'd also remember over that holding period, of our holding period of NVIDIA, as an example, it halved twice. So this is not always completely plain sailing in terms of that straight line. And that's my sort of comment in terms of hindsight bias. And I think what we're trying to do is kind of balance the idea of letting your winners run, but not to the point, but then also managing the stock-specific risk side. And there's loads of examples where you can see stocks that had great runs, and then they fell sharply. Yeah. Great runs fell sharply, and the ones that the market tends to remember is the straight line up. And I think what we're saying is, we're happy for stocks to run, say, 5.5% of our portfolio. We may either trim them. That doesn't have to go all the way back to 3.3. It might be that we take 50 basis points or 1% potentially. And that way, we're sort of taking profits as we go up, but we're not just sort of trading it. We're not just trimming it every single day and not benefiting from that share price rally. I think the flip side is also interesting. If a stock is underperforming, we've got to really think about: do we want to add more capital? And if we don't, then maybe we should be thinking about selling it. And so I think it kind of works on both ways in terms of that, giving you some guide rails, trying to avoid some of those behavioural biases, and then just giving yourself a good nudge or a kind of a good point of sort of systematically questioning your thoughts, because it's really easy to fall in love with a company and think it's absolutely brilliant. And actually what you really want to do is to have a more sort of objective view and saying, well, it's got to this point of the portfolio, it's had this run, the valuation now looks like this. Should we still be owning it in that way, or maybe we should be taking some profits?
The fund does have a substantial allocation to the US, but if we look at themes like AI, some of the big returns in the last year have actually come from Taiwan and areas like Korea. So how tempted do you get to look a bit more beyond the US?
Yeah, so I think, so we took over, I've been running this strategy with my colleague Matthew Page since 2009. I think if you go back all the way to then, the MSCI World, our benchmark, I think the US weight was around 50%, I think it was 52%. Today, it's about 72%. So what you're seeing, you have seen over this period the dominance of the US equity market, but also the dominance of those very large companies within the US equity market, which therefore reflect in terms of that big weight in the benchmark. So I think if you look at our benchmark relative weight to the US, it's about the same. right? And that's partly a reflection of what I just described. We absolutely do look at other companies outside of the US, and I think we'd be, to some extent, agnostic in terms of where they are. Obviously, we'd want to be thinking about if it was more an EM, for example, there's currency risks and things one would need to consider. But we have had lower weights to the US and maybe more weighting towards, say, Asia Pacific and or Europe. I think today, if you look at something like specifically, South Korea, so we do own, in terms of Taiwan, we do own Taiwan Semiconductor as an example. If you look at something like South Korea, that's been very dominated by the memory makers, and that's been SK Hynix, Samsung, for example, and that's been a somewhat unique story in the sense that you've had this massive demand and a big kind of curtailment of supply, effectively not being able to meet that, and it's been massively price driven. I think when we look at those types of businesses, they are generally kind of more commoditized. So actually it's a lot about, it's not that it's sort of technologically difficult to create more supply, but they just can't keep up with what's been a sort of absolutely rip-roaring demand that we've seen in a very short period of time. So I think that's not something that we're necessarily chasing, by the way, but we would be open to looking at those sort of different countries and different areas. I think at the moment, again, it's more bottom-up driven. We're generally finding better opportunities in the US. But remembering again, most of these companies are very global in nature. It's not really necessarily a bet on the US, if you like. These are global businesses, and if you look at, say, the kind of the revenue distribution in terms of the economic exposures, is going to look more broad than just sort of the happen to be where the domicile of these companies that we own are.
And what recent activity has there been in the fund?
It's been relatively light this year. I think we've generally been pretty happy with what we owned. The one change we've made this year is we sold our position in Adobe. So that's been had been a very strong position in the portfolio, and then obviously that's turned. And I think we've been watching that for some time, and then ultimately this year we took the view, particularly with what was happening in terms of the software sell-off, that actually we do think this is a company, although it's offering very good value. I think it's probably single-digit PE at the moment. I think our view, it was difficult to see how that competitive threat they could come through. We've subsequently seen the CEOs left, the CFOs left. There's a lot of question marks on that company. And in its place, we bought AMD. So a company that had been performing more strongly, again, more exposure to the semiconductor space, but we also there's kind of a number of ways to win for that company. So we've seen, not only are they challenging within GPUs, it's done particularly well more recently within CPUs, and we think that's quite an interesting area where it's not necessarily that pure play bet, if you like. They're slightly broader, and we think that's something that again we think has that long pathway to growth, and so far that's been working quite well. Finally, our usual question: do you have skin in the game? I do, yes. Yeah, so I'm, we run 2 global strategies, myself, my colleague, and all of my pensions invested in those 2 strategies. So I don't have any kind of external investments otherwise within my pension. Ian, many thanks for your time. Thank you. And thank you for watching. Do let us know, as always, what you think in the comments. And if you're a fan of this series, hit the like button and hit the subscribe button. Thanks and take care.